passive income investors that are looking for dividend stocks to buy are in for a treat here, as I'm going to highlight 3 ridiculously cheap dividend stocks you can buy that will generate passive income. I'm going to share with you the reasons why I think these stocks are a buy. I'll share with you my discounted cash flow valuation calculations to demonstrate why I think these stocks are ridiculously cheap. And then I'll share with you some of these companies' revenue growth, operating profit margin, and return on invested capital to demonstrate that these are quality businesses selling at cheap prices for dividend stock investors to buy. Let's take a look.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I first wanted to show you the revenue growth of these companies over the previous decade, and they're all in line with that low single-digit growth rate that you should come to expect from these types of investments. Procter & Gamble has grown its revenue from $71 billion to $84.3 billion, and that growth rate has accelerated since 2019, but for the previous decade, it's generated compounded annual growth rate of 1.9%. Similarly, Colgate-Palmolive has increased revenue from $16 billion to $20 billion. That's good for a compounded annual growth rate of 2.4%, as well as Clorox, who has also grown revenue at the same rate over the previous decade. Looking forward, there's a few forces that are impacting these businesses. First of all, tariffs are making it more difficult for these companies to manufacture and source products and materials outside the United States. That being said, these companies have strong pricing power they can generate by increasing prices that consumers pay. Consumers have shown a willingness to trade down and buy store-branded products that are lower priced compared to these branded products. But overall, these companies have demonstrated an ability to increase prices over decades and still generate significant growth in market share and significant maintenance, I should say, of market share, holding down their forces. Looking ahead, tariffs will impact their difficulties in sourcing materials, but overall, they should be relatively well compared to other products and other businesses. The next highlighted metric I would like to share with you is the operating profit margin. Procter & Gamble showing the most skill here, increasing their operating profit margin from 19% to 26% in the previous decade. Colgate-Palmolive generates a respectable 21% operating profit margin while the trend has been downward. And Clorox is recovering from the lows of 2022. Remember, Clorox benefited significantly from the pandemic when its disinfectant wipes were in super high demand. They were selling out everywhere. And then when the economy reopened, demand for those products decreased, and it's difficult to manage a business with such unprecedented increases and decreases in demand. Clorox is doing relatively well. Its operating profit margin is now back up to 16.7%. Additionally, when you measure the returns on invested capital, they all boast ROICs that are above their weighted average cost of capital, which means they're adding value to shareholders. Colgate-Palmolive has the best in this regard at 26%, Clorox second best at 21%, and Procter & Gamble is the lowest at 15.4%, but is demonstrating the most improvement, up from 9.6% in 2017. So now that I shared with you some of the critical financial metrics, let me share with you the valuations, which led me to believe that these companies are significantly undervalued. My discounted cash flow valuation model calculated a fair value for Colgate-Palmolive stock at $165. It's currently trading at $83, so almost half of the intrinsic value is the current market price, which to me, I think that's a significant discount for a relatively attractive business. It's not going to double your money overnight, but it should deliver you excellent returns over the next decade, dividends included. Procter & Gamble, I calculated a fair value of $224. The current market price is $158. And similar to what I said about Colgate-Palmolive, this company should deliver excellent returns over the next decade, dividends included. And last but not least, Clorox, I calculated a fair value of $212. The current market price is $123. These companies are selling at these ridiculously cheap valuations. due to the fact that the tariffs are going to negatively impact these businesses, and investors are not very confident in these companies' ability to mitigate those challenges. Investors are seeing customers trade down and buy lower priced products, store branded products, and investors are skeptical that these three companies can exercise pricing power to maintain their profit margins without losing significant market share to these store brands. However, I think those risks are overblown. I think these businesses have been around for a long time and met with challenges and proved to investors they can overcome these challenges and they can generate, in my opinion, low single digit revenue growth rates for the foreseeable future. I'm talking between 1 to 3% and 4% if you're lucky revenue growth, with operating profit increasing by more than their revenue growth is increasing. So these are for investors looking for a relatively safer investment, not going for those high risk, high reward type situations. These are low risk, low reward type situations when comparing with most other stocks you'll find in the market. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.